for joining us for our conference and panel. My name is İlknur Kocaer, Ültan. I very happily serve on the board of CFA Society Istanbul, and also I'm responsible for investor relations and sustainability at ICE Entera, which is a leading energy, renewable energy producer of Turkey. So I come to this discussion not only as a finance professional, but as an individual very deeply passionate about the green energy transition. And energy transition is it's happening, it's here, it's not only an ambition right now. And we also listened from Mr. Şimşek's presentation for the during the last 5 years in Turkey, it doubled to more than 50% in terms of production share of renewable energy. So it's happening, and it will need more investment in the coming years. So, but the speed alone is not enough. We heard a lot of uncertainty during today's panels, but for the energy transition, we need definitely clarity, we need capital, and we need courage above all. So today I'm joined by very outstanding group of panelists, and they are leaders, thinkers, and they're not only observing this transition, but they're also shaping it very actively. So before we dive into our discussion, I'd like to invite each of them to very briefly introduce themselves. Gabriel?
Thank you. It's nice to meet you all here today. My name is Gabriel Thoumi, and a special thanks to the CFA Society of Istanbul for the very warm reception and a phenomenal event. You know, I'm going to be American here, and so let's give a round of applause to the CFA Society of Istanbul. It's been what a great event. Now, my background, my first sustainability project was probably before many of you were born, was in 1987. And I worked in 1987 to 1992 part-time in sustainability, mostly doing oceanographic research in the North Atlantic, looking at plastics and waste. And then I've been working in sustainable finance for over 20 years. And I'm the CEO of Responsible Alpha. But I'm also a CFA, but also a certified ecologist. So plenty about me. Thank you.
Hello, my name is Brazda. I'm one of the equity partners in PwC, which is the leading consultancy firm in the world. I'm based in Prague, Czech Republic. I oversee 25 countries in the Central Eastern Europe when it comes to financing, infrastructure, green transition, economic transition, etc. And I've been working in many countries, London as well, UK. But I think that what is most important, that I really love Turkey and Istanbul. And we used to meet in Istanbul like every year or so in PwC, so I'm very happy to continue with this tradition. I'm also very happy to be invited by the CFA Society here. Thank you.
Good afternoon to everybody. I'm Dorin. I come from Romania. I am the CEO of Atrium Infrastructure. I have been previously a banker for about 15 years, a bit more than 15 years. Then I have joined the private equity / infrastructure fund management world. I worked for the Free Seas Investment Fund. I was a founding director. Then I moved into a senior investment manager role, senior investor director role. The fund deployed about 850 million euros of equity into projects exceeding 5 billion during my time of involvement there. It was mainly in renewable energy. More than half of it went to renewable energy in Eastern Europe. And we looked at, including my more recent tenure with Atrium, we looked probably at close to 300 projects in the sector. And we have deployed capital in renewable energy in 8 countries and in other infrastructure assets, one of the important ports in Bulgaria, the largest data center in Estonia, and the railway stock company in Poland. I am also sitting on the board of the recently established Romanian Development Bank, which is a very important project for the country, I would say, as a non-executive independent director, and on the board of the largest Danube transport company, integrated Black Sea ports, Danube ports. We operate 8 Danube ports, the largest fleet on the Danube. It's called TTS. It is listed in Bucharest. and also on the index committee of the Bucharest Stock Exchange. But the most important highlight I can bring here from my career is that I have been the first speaker ever to stay on the stage of to speak on the stage of the CFA CEE investment conference at the inaugural edition in Bucharest in 2012, when I had the honor of being the president of CFA Society of Romania. I've been a volunteer with the society for more than 15 years now. So really glad to be here, and a big thank you from my heart to the CFA Society of Istanbul. The conference was a bit of a kid, like one of my kids almost. I really believed in this project, and I'm grateful that it has reached the 11th edition. So thank you for having me here, and thank you for keeping this thing going.
So, a lot of experience now on the stage, as far as I understand. So, we will have 2 Slido questions before we start, because our discussions will evolve around these topics. So, first question, what does drive companies most in pursuing green energy investments? Business opportunities and cost concerns, investors, customers and employees, governments and regulators. I will give 5 seconds. The answers is coming. Government and regulators. Okay. Almost 50%. So, a second question is, what are the most impactful trends to shape the future of energy business? Green hydrogen, nuclear power, and small modular reactors, SMRs, battery storage solutions, and lastly, AI. Okay, nuclear power and SMRs. And AI is also close.
Huh. Not many Germans here, probably.
So, okay. Let's begin by setting the stage. So we all recognize that financing is at the heart of green transition, green energy transition. But is the current financial ecosystem, along with the existing regulatory frameworks, really doing enough to accelerate this shift?
I mean, on one hand, yes. On the other hand, no. First thing, we need to look at green finance. And green finance is old. It's been around for a while. I designed a green bond in 2006. It's what, $5 trillion in green ESG-linked bonds or similar bonds have been issued since inception. So this is a standard practice. It's not new. It's not novel. So what that means is there's a lot of history to borrow from on how to then standardize green finance or climate-related finance for your institutions. So now it's the time to act. I mean, if you think about a communication model where there's 3 buckets, the first bucket is the innovators, that's 1% of the market, right? The second bucket might be the businesses that are interested in a new product, that's the next 5%. Then there's the other 94%, right? That's where we need to be at. We don't need to be smart people on stage anymore, we need to be carpenters. We need to be there 94% of that. We need to be in the mainstream, putting solar panels on roofs, improving infrastructure so people can ride a bicycle to work, which has significant co-benefits related to health and other issues. And so green finance is here. It's standard. It's rather boring now. It just needs to grow. And when you think of like the Central and Eastern Europe, and how it's defined for this conference, about 1% of green bonds have been issued in the region versus total globally over by volume. And it's even less when you think of just Turkey specifically. And so that's the opportunity. Just go to your office and start deploy green bonds. There's very good methodologies out there. They've been tested for 10, 15 years. If I, as a junior analyst, was on a green bond fund, 14 years ago, you can do it too. So it's just time to act.
Okay, thank you.
Maybe I'll just follow up what Gabriel said. Just put things into perspective, because the difference between US and Europe is that in US all the corporate investments are heavily driven by the capital market solution. I think it's 80% is actually coming from the capital markets, whereas in Europe 80% of the finance invested by the corporates are coming from the banks. So it's a very big difference who's actually driving it, and only 20% in Europe is actually coming out of equity or corporate debt, like bonds. Yeah. So I think we are not necessarily comparing the US and the Europe at the moment in the right level on the absolute scale. But I mean, having said that, and I agree with Gabriel, it's still tiny fraction in Europe, but it's changing fairly quickly. And one of the facilitators is also the set of the first question on the slide was whether the regulatory things are actually pushing towards the ESG. I mean, they are in terms of the bonds, because they are making things transparent in a way, coming with the EU taxonomy, coming with the regulation like CSDR, etc. So making really the definition of what is really green and is it really green? Yeah, because the last thing that the institutional investors want to be basically challenged by the greenwashing by investing with something that somebody says is green but it's not. So I think right now the European Union and Commission is doing a good thing, basically somehow to harmonizing all the various frameworks and basically saying what is green and what is not. And maybe last point on this US and EU relationship. This is quite interesting, because since Trump was newly elected, we see a massive inflow of capital, the green capital, from US to Europe. We are CFA, so I'm not sure whether it's correlation or causality, but there was a $10 billion drop of ESG-linked capital in US, basically exiting US, and $15 billion increase in ESG capital invested in Europe. Are they the same money? I don't know, who knows, maybe somebody knows. But for me, it's also interesting to see this trend that basically by the geopolitics and by basically one president in one country, how the total flows of the capital markets can be changed within a few months, when it comes to the ESG. Because you know that the biggest banks in the US, they actually exited the net zero bank alliances, the 5 biggest ones. Whereas in Europe, it's quite the opposite. All the big banks, they actually reconfirmed their net zero KPIs and goals, etc. So we see that now some kind of divergence between the US and EU markets when it comes to the green capital, and this is quite interesting to observe, at least. And it can be also the opportunity for us, the Europeans, or the CEE in general.
Thank you, and Dorin.
I'm going to build up a bit on what Gabriel was saying about green bonds. If I remember correctly, are 1% in Eastern Europe and very low compared to the level you would expect it. And also on what Jan was saying about the structure of the capital structure, basically, and distribution between banks and equity. I will start by saying I'm no expert on Turkey, so I think I'm no expert on anything, but I have no experience, no hands-on experience on Turkey. But what we're seeing in Eastern Europe, in my experience, is very illustrative with regards to your question. So the simple message is that we have to secure capital for the projects, because otherwise there can be no projects. And this is apparent if you look, for instance, in various countries. I'll give the example of Romania. There are more than 50 gigawatts of renewable energy projects permitted in various advanced stages of permitting. In the recent years, less than 1 gigawatt is going online this year, and optimistic people are saying 2 to 3 gigawatts will go online next year. It's big numbers, but compared to ambitions and permitting, it's really a very tiny fraction, and it has to do with availability of capital. Now, availability of capital, in my view, has three important barriers. First of all, there is a significant lack of institutional capital dedicated to Eastern Europe. So you don't have any massive infra energy fund dedicated to Eastern Europe, and you have small and fluctuating allocations from the big European infrastructure funds, right? So this is very problematic, and it becomes contextual. Funds would come and go depending on local politics. So there's no one that has sees Eastern Europe and these countries as home market, and that's problematic. You have no international capital present here, and I'm speaking about equity. This hurts obviously the equity component. The second is, I would call it indirect, and it has to do with the functioning of the commercial markets for energy. If you look at the long-term bilateral contracts of power producers with industrial and economy consumers, like companies, large companies, the numbers are staggering. I mean, throughout, the notable exception is Poland. So I remember numbers from 2023. There are close to 40 PPAs signed in the geography that we looked after in Eastern Europe. Spain had close to 100, France had about 50, and out of the close to 40, Poland was around 3/4, right? So it's really difficult to finance with debt important projects, mega projects for banks, unless you have these long-term predictable revenues which come from long-term contracts. So you have a difficulty in the functioning of the commercial market for energy, and it's a major gap versus Western Europe. And the final point, which I think is close to heart and closer to our capacity and capabilities as CFA societies and as capital markets practitioners in the region, has to do with the availability of local capital. Institutional capital is already largely available in the region. So if you look throughout the region, you will see that pension fund assets, and again, I'm not including Turkey because I don't know, but pension funds assets exceed 100 billion. They are close to 150 billion euros. So what happens is when you try to attract international capital, for instance, from pension funds, in our experience, they would ask, where is local capital? And if there is no local capital, the very funny question I received, and I use it, I remember it a lot, is what do they know that I don't know, sitting in Montreal, Canada? So local capital needs to be developed and geared towards the green transition. And you've seen from Mr. Fatih Birol on this stage earlier that the green transition driver is actually financial returns and renewable energy being cheaper. So that means that it's not a bogus investment. It's a genuine opportunity, right? So that's the final, I think, roadblock. Pension fund allocations to alternatives in Eastern Europe are close to 0%, less than 1%. Mm-hmm. In the global average is about 12, and in developed markets it ranges from 8-9% all the way to 40 for some higher risk type of products in the US and North America. So that's, I think, the final kind of point in my mind that kind of hinders availability of capital in Eastern Europe for renewables.
Very good points, and for Turkish companies, opportunities there obviously, but the capital, etc. So, and we just earlier spoke with Dorin that the Turkish electricity companies are very interested in Europe, in Romania. So, but they need capital, and definitely the green financing is very important here. So. We touch base the companies, but if we go into detail, so we also ask the audience what are the motivations of the company. So the companies are at very different stages of investments. And the motivations are also different. Our audience talked about the government and regulation pressure, and also they also mentioned the obvious business opportunities and cost. Efficiency maybe, and what are your opinion on that? What are the main motivations on your in your view? And once the companies decide to act, what do they need to do? What do they need to put in place in order to seize the opportunity and tackle with the challenges?
Okay. Well, I think companies need to be smarter. I mean, segment the news or the noise of the news from reality. We're data-driven experts. We know data. That's for part of the CFA program or financial analysts. If you just look at, as an example, the panel is called Energy and Sustainable Finance, right? If you look at sustainability, one of the key metrics in ESG, and G, under governance, is number of people on the board. So does anybody know how long that metric has been required under New York law for companies in New York? I mentioned a couple to other people earlier today. Does anybody know? Okay. Since 1811. 1811, New York corporate law said, report the number of people on the board. So, and we have this with many of the other underlying metrics in energy finance and sustainability, and within sustainability specifically ESG. There's a very long history for these metrics. CFA Institute itself was initiated through Graham and Dodd. If you read their books, Security Analysis, they talk a lot about data governance and issues related to governance. And that book is from 1928 and 1929 and formed the basis of the CFA Institute. So I think companies need to put aside the noise and stay focused on their strategy. Stay the course. Yes, it's turbulent times. We have an American president. You can ask me offline about that. What I can say publicly is I was sued by 22 states to keep me to not talk about climate change. And guess what I've done? I'm here talking about climate change. I stay the course, because the climate is changing. It's real. So what are we going to do about it, And so we have to just look at the facts that we're facing and move forward. So businesses need to be smart. They need to be wise. They can be humble and curious in how they go forward. Or like you were being I loved how you described courage and capital, yes. Bringing those two together. And so that's my sort of 2 cents today.
Okay, that's interesting. I was prepared for a completely different sort of answer, but I saw the results from the slide, so I would like to comment on them, that people think that the government is the biggest driver for the energy transition and the carbon footprint reduction, etc. I think that in the CEE we see this slightly differently when you ask the companies, etc. But maybe this can be specific to the sea, where we are part of the global or European global supply chain, where our factories and companies are supplying to somebody else who is taking all the profits and all the margins, etc. But this is fine. But I already mentioned the banks, but some of the banks in Europe, their goals and net zero goals are actually much stricter than the regulation, than the governments want. Yeah, but it's not just the banks; these are also the corporates. I saw the Škoda car just outside of this building. So just a very concrete example: Škoda Auto is part of the Volkswagen Group. Volkswagen Group very strict targets about net zero, carbon reduction, etc. Being cascaded down to Škoda. Škoda has 1,000 suppliers in the Czech Republic. 1,000. So these goals are being basically cascaded down to the 1,000 suppliers. And from the last year, the Škoda, when they are basically making or selecting their suppliers, it used to be only price, quality, and time. Now it's price, quality, time, and carbon footprint of the product or service being delivered. Yeah, whether it's aluminium or plastic or steel, it's already in there and it's being evaluated. So you see that immediately through one goal of one mother company, 1,000 companies are basically reducing their carbon footprint to stay in the game. Otherwise, they'll be replaced. And I'm just mentioning that because the Škoda is also big, sort of quite successful in Turkey, and also having some suppliers in Turkey as well. So you see how this is being cascaded down. And I think this is not a governmental-led driven initiative. This is a corporate-based, etc. So I think I like all of these examples as well. And maybe one last point on the CEE, because the Turkey, you are more like diplomatic and independent, sometimes like a Switzerland, I would even call it. But in western part of the sea, we are not. We are really like anti-Russians, blah, blah, blah. So part of the net zero transition is not really caused by the climate change over the last 3 years. It's really by the war itself, because the biggest carbon reduction is being done after the full-scale war on Ukraine, where basically people realize, we need to be independent, we need to be secured. We don't want to be reliant on fossil fuels to be imported from Russia, etc. They are doing everything they can to basically get rid of it, and it's actually a massive energy transition and a massive also reduction in the carbon footprint as a consequence. Yeah. So this is also like additional driver which wasn't mentioned as one of the triggers, but I think it's also a big trigger in our part of the world.
Yeah, I mean, if we think about climate change very briefly, then I'll go to Dorin. We have right now the Gulf Stream, that's the colloquial name for the current in the Atlantic. It's about 35 to 40% forecast to significantly decrease in the next 25 years, because it already has. And that would, what the Gulf Stream does, it's like the HVAC system, it's like the heating and air conditioning system for Europe and for the US. If it collapses, the summers will be much hotter and the winters will be much, much colder. They're looking at a forecast of up to 5 to 8 degrees Celsius decline in temperature. That's our lifetime. So if I'm Volkswagen and I have a fiduciary duty and I'm on the board, I have a long-term view, I want to drive zero emissions into my supply chain because I want to, from a risk management perspective, protect my assets and ensure their continuity.
Yeah, that reminds me of the intervention earlier by the minister, and that's like the big VUCA moment right there, right? With the Gulf Stream, it's volatile, it's uncertain, you get everything, complexity, and going back to your question, so I think I found it very compelling again listening to Fatih Birol earlier today. Renewable energy, I mean, in the energy mix, recent assets delivered were, I think he said 85% are renewable assets. And he said that they're simply cheaper. And I do agree with that. So for me, the main driver, of course, not dismissing the very clear and correct point from Jan, the main driver is cost efficiency behind this trend. Of course, I mean, the audience, a lot of the people of the audience highlighted the role of the government. Obviously, subsidies and regulatory and government support is part of that, but the way you look at it from a corporate or investor perspective is ultimately, does it make sense economically? Because if it didn't, then you wouldn't do it. So the question is, were indeed subsidies and government supports fundamental to a degree that we rank it first or second, but the basic corporate decision, I think it has to factor in cost significantly. And that kind of, if you look at the energy transition to date, particularly in Europe, the massive improvement in technology for solar, for instance, was driven by massive investment, which initially was supported by massive EU programs. So kind of it was subsidized initially. It attracted a lot of capital on the back of those subsidies, which meant money was driven to research on that topic. The whole technology became more efficient. And I think that's kind of the question about, because I think your question was also about what lies ahead and how should company look at the next challenges. And I think the next challenges now are about how you deal with overcapacity, particularly in peak hour periods, for solar, for wind, depending on the geography. And the answers around that lie in three areas, and the three areas I think are transmission, which is massively overlooked. So if you look at public statements of any government in the region or any, decision maker or even corporates, and they would say how much gigawatts of renewable energy want to build. Nobody says I need to build 3,000 kilometers of grid in order to properly, deploy that capacity. So I think transmission is very important, and that's more on the macro level. Second is about storage, and here comes the question: is the technology mature enough? Are market functioning well enough? And the answer, in my view, in Eastern Europe is not yet. And finally, it is of course financing, my favorite topic, as you saw from the first question. It will depend a lot on the financing availability and on the financing models that banks and equity investors manage to put together in order to support corp. So I think if I were a corporate, these were the things I would be looking at. Can I jump into these trends and how can I do it well?
Thank you. And we have 5 minutes left, so I will just ask you the question that we asked audience earlier. So. Among the next-gen technologies, which are basically hype, but the overall investments seem to lagging the hype. So, which technologies do you believe that will truly shape the energy sector in the future? So we got the answer from our audience. They specifically mentioned nuclear and SMRs, and maybe after that the AI. So can I take briefly your views on that?
Okay, well, so no and yes. Okay, so let me explain. AI, there's significant efficiency gains as AI itself becomes more efficient, right? So AI, so we see like in China, 80% of the data centers that were expected to go online in 2024 were canceled. They don't need them because the large language models are becoming more efficient. We saw that with DeepSeek. So the AI using energy, while it's forecast in the US to go to about 6% or 7% by 2030, 35, that's probably not going to be as high, right, for the electricity use. SMRs, there's still no viable SMR, small medium reactor. There's still no viable commercial model that we have seen. There's ideas, there's aspirations, but we still haven't seen nuclear in almost most contexts globally to actually be financially viable. I used to cover nuclear when I was at Calvert Investments. Now, the technology that we will see very rapidly grow is battery storage. In the United States, we see it rapidly growing right now in Trump's America. In Trump's America right now, 93% of the gigawatts that are forecast to be built this year are renewable energy. 93% in Trump's America. Right. So again, don't watch the news. Look at the data. Don't doom scroll. If you've heard of that, don't do that in the middle of the night. So battery storage is going to really take off, like in the U.S. and other places. They can link solar to battery storage, and there you go. So AI, I don't really think about. SMRs, we don't see a model yet. Yes, I appreciate that. Chaz just bought 50% of Rolls-Royce SMR. I'm very curious about that. And battery storage is where you go.
Yeah, I would tend to agree, but I will mention also the other technologies that are on the slide for some reasons, because I do work a lot on hydrogen and carbon capture, which are the projects which are getting to the headlines, but not necessarily like people will actually see them in practice. And I was a keynote speaker on the COP29 in Baku on hydrogen on a plenary session, and I remember it was like 6 months ago, right? And I was showing that half of the project in the world in the hydrogen were either cancelled, slowed down, or postponed. So I was hoping to have some good news for this panel, but it's still the case, unfortunately. But on the other hand, it's exactly what Dorin said. I mean, with the right support from the government, you can make things happen, because these technologies they are immature, they are risky, there is no demand, obviously. And then if you couple this with the investors on the other side, that's complete opposite what they want. Yeah. But I mean, if the government step in, it doesn't necessarily have to be like subsidies, like spending millions of. It can be the same like on photovoltaics in 2009 and 10. There were government step in through feed-in tariffs, through long-term contracts, etc., and then through the R&D, etc. The photovoltaics panels dropped by 85% capex. This is huge. Yeah? The same can happen with hydrogen if the governments or city companies try to basically offtake the hydrogen instead of gas or petrol, etc. So I think it's just a matter of political will and then a good decision on which technology will prevail. But I think all technologies we will see them in the future. But it's really hard to predict which one will actually win in the long run.
And Dorin?
Yeah, I think we don't want to go, Jan, into the support schemes in Romania and the Czech Republic for renewables, because those were, yeah. So I think the brief answer for me, nuclear is needed for scale and for growth, and I am a believer in the fact that energy demand will continue to trend upwards. I agree that probably slower. I'm not an AI specialist, but I do see that there's economies. However, it doesn't mean that the growth will stop. It just means that the growth will be much slower, right? Gabriel, I think we can agree on that. So demand will be there, and I think the technology that can deliver at scale, predictably, constantly, is obviously nuclear. The more interesting, for me from a micro level is storage. And in storage, the challenge now, I think the technology is pretty much evolved, but you have a challenge with regards to the revenue model. So when you want to finance a heavy capex project, like the battery, recovery period over a number of years, you need sustainable, predictable revenues. The revenue model for batteries can come from volatility, from arbitrage or trading between various periods. It can come from technological system services. It can come from balancing. It can come from integrating with an existing project, or it can come from voltage regulation, right, of the system, particularly of the distributor systems. None of these are predictable long-term revenue. So I think I know it's a bit technical, but I think an important move from the regulators, the governments, the EBRDs of the world, would be to find products that would stabilize revenues for storage for a period of, say, as short as 5, maybe 10 years. And then you can deploy such products at scale, and all of a sudden your peak wind and solar production can become a much more evenly distributed and efficient profile. And again, as was said in this stage by one of the highest authorities in the energy sector, renewables are the cheapest source of energy now if you manage to, deal with the peak problem of their producing capacity.
Thank you very much for this very good discussion, and it's a wide-ranging discussion, let's say. And let's stay connected, and let's continue to learning, actually. And speaking of learning, CFA Institute truly equips us for the future, and as the finance professionals, financial modeling, investment analysis is not enough. So we have to learn ESG risks, climate concerns, and also stakeholder engagement. Yeah. So CFA Institute has several certificates, and Sustainable Investing Certificate I very recently completed. And I can tell you that is a very powerful tool to integrate ESG considerations into investment decisions, and also climate risk valuation and investing certificate. It also enables to simplify very complex climate concerns and facilitate effective communication with investors. So we also encourage you to look into the certificates. So thank you very much for joining us today, and thank you.
Thank you.
Thank you.
Thank you.